Hello from Nashville, Tennessee. This is my Q2 2013 Market and Wealth Management Update. So a couple of things are different about this video. A, I'm filming it from our new office, so I'm mixing it up a little bit with a change of scenery. And B, I'm now calling this Market and Wealth Management Update. Why? Because I think it's important for me to throw a few thoughts about financial planning each quarter versus only focusing on the market. After all, it is my job and Raymond James to focus on the market in your accounts, but it's really your job to make sure that you get the proper financial planning done for your family. And we certainly can help. So there you have it. Let's get going here. Oh, and one more thing that is different this time. I'm going to try being the key word, to shorten these videos to around 5 minutes versus my typical 10 to 12 minutes. So one of you, and I won't mention names because we are, after all, live on YouTube, said last time, David, you sure like to talk. Talk. I mean, I really enjoy listening to you, but boy, you like to talk and get excited. And while I initially, of course, took that to mean, oh great, I should just talk more, I feel pretty confident that Martha and Siobhan, and most of you know Siobhan Farler, my Director of Client Operations, and Martha Brown, my Director of Client Experience, I feel certain that they would confirm that what was really being said by this unnamed client was, very politely of course, David, keep the excitement going, but get to the dang point. All right, so I probably just wasted about 2 minutes, which is ironic. I see the irony in that. But let's do this. In a nutshell, I'm going to go ahead and cut to the chase and say that while I am thrilled about the current market run, I'm now anticipating a pullback, a correction if you will, but nothing like the 2008 recessionary pullback we saw. And while I neither claim to be a market timer or am I a market timer, I wouldn't be surprised to see a 5 to 8% pullback in the near future. But I also could see this market continuing to run a little based on momentum until we hear about the government debt situation again. And at that point, I think that could be a catalyst to trigger that pullback. I know many of you are probably rolling your eyes thinking 15 to 20% pullback is likely, but here's why I think that's too high. Any volatility is likely to get bought off immediately, meaning that people are expecting it and they have cash on the sidelines. And what's been happening is any day we see the market down 200 points, it gets bought back immediately and propped up. I just literally had lunch with a JP Morgan economist who agreed that there's about a 5 to 10% backstop on this market due to the excess cash. I do realize that this sounds like saying it's sunny today and eventually it's going to rain, but that's all I have for you. Yes, a typical financial planner answer, but it is what it is. Now, in an effort to put myself out there and to give you something that you can work with, here's what I would do with your current portfolio to weather the current market situation. Now, for all of my compliance people at Raymond James, let me preface this by saying, in no way can I give any specific investment advice to an audience at large. So it's important that you sit down with me or your planner to review your personal plan and your risk tolerance. However, what I can say is this. For a typical balanced investor, and by that I mean a 50-50 investor in stocks and bonds, I would suggest on the stock portion that you continue to place an emphasis on dividend payers to provide insulation, if you will, when things turn around. And also to make sure that you are around half of your equity portion in global equities. As I believe the growth over the next 5 years is primarily going to be in the emerging markets, followed by the U.S., and then lastly by developed international. Remember, the country of domicile for a stock isn't near as important as where the revenues come from. An example would be a bank in the UK I was looking at where 90% of the revenue come from Asia, and it's actually considered a developed international stock, but it really should be an emerging stock. All right, shifting on to bonds. For your bond portion, I cannot stress enough my concern for bonds and interest rates rising in the near future. So Bonds 101 would tell us that typically as your rates rise, your bonds lose value. I've spent countless hours working with institutional investors and firms developing and hiring these fixed income managers that are tactical and can navigate this new era of rising rates we're likely to enter. So for around 30 years now, bonds have had the perfect storm of lowering rates and nearly have performed as well as our stocks. So my crystal ball is a little foggy, but I strongly believe in 20 years, stocks should outperform bonds after inflation and by meaningful proportions. So these tactical managers that I'm alluding to, I've found some that are unconstrained and can go low to negative duration to help dampen the interest rate sensitivity. But maybe you increase the credit risk just slightly to get a better yield. So 2008, I recognize, was detrimental to taking on credit risk, but now corporations have stronger cash positions. Their balance sheets look a lot better and default rates are low. So it may be time to get rid of those long to intermediate term bonds, or intermediate to long-term bonds, if you will, that have been such key investments in portfolios for many years. Additionally, I would not have 50% in bonds, period, no matter who you are. For this hypothetical balanced investor, I would only use unconstrained bond managers and lower the exposure to bonds to around 25%. Then for the other 25% of the portfolio, maybe 15 to 20% of that in alternatives like commodities and energy, and leave 5 to 10% in cash as dry powder for the next correction that I just mentioned I could see coming. So basically, what have we done here? We've repositioned the balanced investor to focus more on equity dividends, bond managers that are well positioned for rising interest rates, and adding alternative asset classes that add a third level of diversification, and then of course some cash to be nimble to be able to buy low. Make sense? Good. Shifting to a quick macroeconomic overview. So at the height of the tech bubble in 2000, the S&P was near the same level that it is today, but valuations were nearly double. 25 PE ratio then versus about a 13.8 now. That's according to the S&P and FactSet. So stocks are more expensive today than they were last year, but still historically cheap, and much cheaper than some previous bull markets. So I think there's still room to run up for the market, that is. The big four cyclical sectors that I always talk about, light vehicle sales, inventories, capital good orders, and housing starts, are all still trending upwards towards their historical averages. Consumers' balance sheets are continuing to look better. Household net worth is approaching an all-time high, and that's according to JP Morgan. And consumers' debt ratios are lower and they're saving more. These are all good signs. Now in Washington, all eyes are on the budget and the debt situation, as the 2013 budget currently shows about a projected $845 billion, yes, billion, dollar deficit. As of now, the Democrats seem to be upset that Obama isn't taxing enough and isn't looking to cut spending more, or is looking to cut for more spending cuts than they like. So we shall see how the world reacts to our new spending and taxing policy, or will they just punt and put it off again this year? I noticed that consumer confidence, as measured by the University of Michigan, dropped recently after trending upwards for several quarters, as many people think this market is expensive. I addressed my thoughts on this earlier and why this may not be true, because typically consumer confidence and emotions are the worst way to invest. Please never forget that if you don't hear anything else. Now lastly, a few financial planning considerations for this quarter. Long-term care insurance, very exciting subject, I realize. I highly recommend that anybody with over $1 million in assets and between the ages of 50 and 60 and in decent health get with me or your planner to cover this risk. It is by far the biggest risk to depleting a portfolio and not having a lifetime income that I've seen to date, and it's becoming more and more so that way. As much as I hate insurance premiums and our industry's tendency to overinsure people, you can't afford to not have this conversation and at least look at it. Now, my team has specialized in this area for going on 10 years, so we're happy to help. One more thing to point out, my team's also spent time educating our clients on strategies designed to maximize Social Security opportunities. And we have a top-notch resource right at our disposal to do custom solution planning for you on this topic. Too many people are taking Social Security early and they think that it's best, and that what's really happening is you're giving up an 8% a year increase in benefits to the age of 70. Additionally, many aren't aware that there's something called file and suspend, and this is a strategy available at full retirement age. I'll just tease you and stop there and say you have to call us if you want more. All right, so while I'm pretty sure that wasn't 5 minutes, but I bet it was under 10, at least I improved. And after all, that's all we can do, right? Try to keep getting better. Until next time, remember there are more important things in life than money. Life's most precious commodity is time. Let us help with your finances so you can focus on your family, your faith, and your hobbies. See you next quarter.